If you opened your banking app this morning to check your balance, to pay a bill, to move money, and you saw something that made your stomach drop, you are not alone. You did not imagine it. You did not click the wrong account. You saw exactly what millions of other people saw. Zero. Not low funds, not pending, not delayed. A flat $0 balance staring back at you from the screen. And in that moment, before the explanation, before the press release, before the word glitch was pushed into the headlines, something more important happened. Trust broke. The official story, already circulating, is that this was a technical issue, an overnight processing error, a routine systems problem that has since been resolved. That framing is meant to calm you, to slow you down, to keep you from asking the only question that actually matters. If the money was there, why did the system ever show zero? Because what you saw was not just a display error, it was a stress signal, a moment where the plumbing failed, even briefly, and exposed how fragile the system really is. Banks do not show zero balances unless something underneath them cannot reconcile. Ledgers do not default to zero unless they cannot balance in real time. And when that happens, the problem is never cosmetic. It is structural. Here's what matters, and here's why you should be paying attention right now instead of dismissing this as a one-off incident. Wells Fargo processes millions of transactions overnight through automated clearing systems, payroll deposits, government transfers, scheduled payments. This all happens while you're asleep, in batches, at scale, with very little margin for error. When that system works, you never notice it. When it doesn't, you wake up to a number that should never appear, zero. And when that number appears across accounts at the same time in multiple locations, with customer service lines overwhelmed and public communication delayed, it tells you something important. It tells you the institution is reacting, not controlling. You may have already seen the reassurance. Funds are safe. Balances will be restored. Nothing to worry about. That language is not designed to explain what happened. It is designed to prevent a secondary reaction. Because the real risk to a bank is not a software error. It is what depositors do after they see one. Banks do not hold your money the way most people think they do. When your paycheck is deposited, the cash does not sit in a vault waiting for you. It becomes part of a balance sheet. It is lent, pledged, rehypothecated, and transformed into assets that cannot be instantly converted back into cash without consequences. The entire structure works on timing and confidence. As long as withdrawals are staggered and predictable, the system functions. When timing compresses, even briefly, the illusion cracks. That is what you witnessed. This is why the explanation matters less than the delay. If this were truly a harmless display issue, it would have been acknowledged immediately. Systems teams know within minutes whether they are dealing with a front-end bug or a settlement problem. Silence, especially during the most sensitive overnight window, tells you that people were scrambling to reconcile numbers that did not add up. And while you were refreshing your app, wondering if you could buy groceries or cover rent, something else was happening quietly in the background. Liquidity was being sourced, lines were being activated, backstops were being leaned on, not because the system is collapsing today, but because it is more fragile than it wants you to believe. This is not about panic. This is about pattern recognition. Every major banking event of the last 2 decades has started the same way. A small disruption, a contained issue, a carefully worded statement, and then a rush to normalize what should never have happened in the first place. Silicon Valley Bank did not fail because of one bad day. It failed because confidence evaporated faster than liquidity could be raised. The same is true every time. When people see zero, even briefly, they remember it. Some of you will move on and forget this ever happened. Others will quietly change behavior. They will keep more cash. They will spread deposits. They will hesitate before trusting an app the next time a bill is due. And that behavioral shift is what banks fear most, because the system is not designed for everyone to be cautious at the same time. This is bigger than Wells Fargo. Every major bank is operating with balance sheets shaped by years of low interest rates and suddenly higher costs of funding. Assets that looked safe at 0% behave very differently at 5%. Bonds that were once liquid become traps. Selling them creates losses. Not selling them creates exposure. There is no painless option, only delayed consequences. So when you hear the word glitch, understand what it is really doing. It is buying time. Time for balances to be restored. Time for customers to calm down. Time for the news cycle to move on. But time does not fix structural fragility. It only hides it. And this is where it becomes personal. Because the money in your account is not a physical object. It is an entry in a database, dependent on multiple institutions honoring multiple promises simultaneously. When that chain holds, everything feels normal. When it breaks, even for a moment, you see how thin the margin really is. That realization is uncomfortable, but it is also useful. It forces you to think about redundancy, about resilience, about what you control versus what you assume will always work. In the next segment, we are going to walk through exactly how these systems operate overnight, why 0 is the default when reconciliation fails, and what this tells us about the direction the financial system is moving. We are also going to talk about why physical assets, particularly silver, are drawing attention again, and why price targets that once sounded absurd are being discussed seriously. This is not about fear, it is about preparation. What you saw today was not the end of anything, but it was a reminder, and reminders like this do not happen by accident. To understand why balances defaulted to 0, you have to understand how money actually moves when you are not looking. What happens between the moment your employer sends a paycheck and the moment it appears in your account is not magic. It is a chain of promises, timing windows, and clearing mechanisms that only work as long as nothing unexpected happens. Most deposits do not move in real time. They move in batches. Overnight, while branches are closed and markets are quiet, automated clearing systems reconcile thousands of institutions at once. Files are sent, totals are matched, credits and debits are queued, and at a specific window in the early morning hours, balances are updated across millions of accounts. When that process completes cleanly, you wake up and everything looks normal. When it does not, the system has a problem. And when the system has a problem, it does not show partial information. It reverts to a safe state, 0. That is not a random choice. 0 is what appears when the ledger cannot confidently confirm what belongs where. It is the equivalent of a circuit breaker. And circuit breakers are not triggered by cosmetic errors. They are triggered by reconciliation failures. This is why timing matters. Reports did not begin during business hours. They surfaced while the overnight processes were running, before customer service centers were fully staffed, before public communication teams were awake. That is when institutions are most exposed because intervention options are limited and speed matters more than messaging. In those hours, banks rely on liquidity buffers, cash reserves, lines of credit, short-term funding arrangements designed to absorb temporary mismatches. These tools exist for exactly this reason. But they are not infinite and they are not free. Over the past few years, those buffers have been under pressure. Rising interest rates changed the value of assets sitting on bank balance sheets. Bonds purchased when yields were near 0 are now worth less on the open market. Holding them avoids realizing losses, but it also locks up liquidity. Selling them creates cash, but at a cost that weakens capital ratios. There is no perfect move, only trade-offs. So, when a large volume of deposits is scheduled to post at once, the institution must be able to absorb that demand smoothly. If it cannot, even briefly, the system hesitates. And hesitation is enough to produce exactly what you saw. This does not mean money vanished. It means access was interrupted. But interruption is the point. Modern banking is not just about ownership. It is about availability. And availability depends on confidence that all parts of the chain will perform at the same time. When they do not, banks move quickly to stabilize the situation. They activate contingency funding. They lean on counterparties. They access short-term facilities designed to bridge gaps. These actions are not signs of collapse. They are signs of stress. Stress that most people never see. Until they do. What makes moments like this different is not the technical cause. It is the visibility. Millions of people saw the same thing at once. They took screenshots. They shared experiences. They compared notes. And that collective awareness changes behavior in ways spreadsheets cannot model. Once a customer sees 0, even temporarily, the mental model shifts. The account stops feeling like a vault and starts feeling like a promise. Promises are reassessed when they wobble. Banks understand this. That is why language is chosen carefully. Words like glitch and outage frame the issue as temporary and external. They signal that nothing fundamental is wrong. But framing does not erase memory. And memory is what drives future decisions. This is where risk becomes systemic. Financial systems are built on diversification of behavior. Not everyone withdraws at once. Not everyone transfers funds on the same day. Not everyone loses confidence at the same time. When behavior clusters, stress compounds. A small percentage of customers making small changes can have outsized effects. Keeping extra cash, moving balances across institutions, reducing exposure to any single point of failure. None of these actions are irrational. In fact, they are logical responses to new information. But when they occur broadly, they change the operating environment. Liquidity that once moved predictably becomes more volatile. Funding costs rise, margins tighten. Systems designed for stability must operate closer to their limits, and the tolerance for error shrinks. This is why financial history is filled with moments that look insignificant in isolation but obvious in hindsight. A delayed settlement, a frozen fund, a brief suspension that is quickly reversed. Each one is dismissed at the time. Each one is later recognized as an early signal, not because it caused failure, but because it revealed vulnerability. The key point is this. Modern banking works extraordinarily well when confidence is intact. It is efficient, fast, and convenient. But it is also optimized for normal conditions. It is not designed for simultaneous doubt. When doubt spreads, even modest disruptions take on new meaning. That is why regulators focus so heavily on communication. why institutions emphasize a resolution, why assurances are repeated. The system does not just need to function, it needs to be believed. Belief, however, is not permanent. It is earned continuously, and once interrupted, it does not reset automatically. This brings us to the broader question you should be asking right now. Not whether this specific event is over, but what it implies about resilience going forward. Because the environment that produced this moment has not changed. Interest rates are still high. Balance sheets are still constrained. Digital access is still centralized. And expectations of instant availability remain absolute. That combination leaves little room for error. In the next section, we are going to expand the lens. We will look at how institutions are connected to each other, why stress rarely stays isolated, and how small disruptions can cascade through funding markets in ways that are invisible until they are not. We will also begin to examine why attention is shifting toward assets that sit outside these systems entirely. For now, understand this. What you experienced was not hypothetical. It was real. It was brief. And it was instructive. Systems teach lessons when they fail, even momentarily. The question is whether those lessons are noticed before they are repeated. The reason events like this matter is not because of any single institution. It is because no major bank operates alone. Every large financial institution is connected to others through funding markets, payment systems, and shared assumptions about liquidity. What looks isolated on the surface is usually part of a larger web underneath. Banks lend to each other constantly, not for months or years, but overnight. Short-term funding allows institutions to smooth daily mismatches between incoming and outgoing cash. On most days, this market is invisible. Rates are stable, transactions settle, nobody notices. But when stress appears at one node, the entire network becomes more cautious. Lenders shorten terms. They demand more collateral. They raise rates. Borrowers respond by pulling back activity, conserving cash, and leaning more heavily on backstop facilities designed for moments like these. None of this shows up on your banking app, but it changes the environment dramatically. This is how localized issues become systemic risks. The interbank market runs on confidence that everyone else will perform as expected. When that confidence is shaken, even briefly, behavior adjusts. And once behavior adjusts, the system behaves differently. This is not theoretical. It has happened before. In past episodes of financial stress, the first visible cracks were rarely catastrophic. They were delays, pauses, quiet interventions that prevented immediate failure but signaled deeper strain. By the time the broader public became aware, institutions had already been operating under emergency conditions for weeks. The difference now is speed and visibility. Information moves instantly. Screenshots circulate in minutes. Experiences are shared in real time. What once took days to become common knowledge now takes hours. That compresses reaction windows and amplifies perception risk. Perception risk matters because money is not just a medium of exchange. It is a coordination mechanism. People must act based on what they believe others will do. If enough people believe access could be interrupted again, behavior shifts preemptively. That is where contagion begins. Not because banks suddenly become insolvent overnight, but because the cost of trust rises. Institutions have to pay more to attract funding. They have to hold more liquidity. They have to operate with thinner margins. Each adjustment makes the system less forgiving. At the same time, the underlying pressures remain. Interest rates are still elevated relative to the last decade. Assets acquired under different assumptions still dominate balance sheets. Regulatory frameworks have been adjusted to allow institutions to carry certain holdings at values that do not reflect current market prices. This buys time, but it does not eliminate risk. Time in this context is a double-edged sword. It allows institutions to earn through problems, to let assets mature, to rebuild buffers gradually, but it also allows imbalances to persist. It allows exposure to accumulate, and it assumes that external shocks will be mild and infrequent. History suggests otherwise. Economic systems rarely unwind smoothly. They move in steps, periods of calm punctuated by moments of stress. Each episode reveals a little more about where the limits are. What happened with balances displaying zero was one of those moments. It did not break the system, but it revealed how quickly confidence could be tested. It showed how dependent access is on continuous coordination across multiple layers of infrastructure. And it reminded people that digital convenience is inseparable from institutional stability. This is why discussions about resilience are shifting. For years, efficiency was the primary goal. Faster payments, fewer intermediaries, lower costs. That model works best when volatility is low and assumptions hold. When conditions change, efficiency can become fragility. Resilience requires redundancy. Redundancy requires cost. And cost has been minimized aggressively. As a result, systems are excellent at handling expected flows and less comfortable handling surprises. The response to this event will likely focus on reassurance, systems upgrades, reviews, statements emphasizing safety. All of that is normal. It is also incomplete. The more important response happens quietly, at the level of individual decision-making. Some people will do nothing, others will adjust slightly. A fraction will change significantly. Each choice is rational in isolation. Together, they reshape the operating landscape. This is why central banks and regulators pay close attention to seemingly minor disruptions. They are not afraid of the event itself. They are concerned about second-order effects. Will funding costs rise? Will liquidity buffers be drawn down? Will risk tolerance shift? These questions determine whether stress dissipates or compounds. It is also why conversations about alternatives gain traction after moments like this, not because the existing system has failed outright, but because its limits have become visible. Assets that sit outside daily settlement systems behave differently. They do not depend on overnight reconciliation. They do not require continuous access to centralized networks. Their value may fluctuate, but their existence does not. That distinction becomes more relevant when people think about continuity. Continuity is not about maximizing returns. It is about maintaining optionality, the ability to function even when parts of the system are impaired. This does not mean abandoning modern banking. It means understanding its boundaries. Every system has them. In the next segment, we are going to look more closely at those boundaries. We will examine how funding markets react under stress, why backstop facilities exist, and what repeated reliance on them signals about structural health. We will also begin to connect these dynamics to broader shifts in how value is stored and protected. For now, keep this perspective in mind. What you saw was not an anomaly, it was a data point. And data points matter most when they fit a pattern. The pattern here is one of tightening margins, higher sensitivity, and lower tolerance for disruption. Understanding that pattern is the first step toward making informed decisions in an environment that is changing, whether headlines acknowledge it or not. When stress appears in the system, the response most people never see happens quietly and quickly. Institutions do not wait for headlines. They move through established channels designed for moments when normal funding is not enough. These channels exist for stability, but their repeated use tells a story of their own. Every major financial system has backstops, facilities that provide short-term liquidity when markets hesitate. These tools are meant to be temporary, used sparingly, and faded out when conditions normalize. In theory, they are insurance. In practice, they become part of the routine when volatility is persistent. What matters is not whether these tools are used. It is how often, how quietly, and how normalized their use becomes. When institutions lean on backstops, it allows them to bridge timing gaps without selling assets into unfavorable markets. That prevents immediate losses and buys time. But it also shifts risk from private balance sheets into shared systems. The more often that happens, the more the system depends on confidence that support will always be available. Confidence, again, becomes the central variable. As backstops become familiar, markets adapt. Participants assume support will appear when needed. Pricing adjusts. Risk-taking behavior responds. This can stabilize conditions in the short term while increasing sensitivity in the long term. That trade-off is rarely discussed in public statements. Instead, emphasis is placed on resilience, strength, and preparedness. Those words are not inaccurate, but they are incomplete. Resilience is not the absence of stress. It is the ability to absorb it without cascading failure. And absorption has limits. The more frequently stress must be absorbed, the narrower those limits become. This is why repeated, seemingly minor disruptions deserve attention. Not because they signal imminent collapse, but because they show how much intervention is required to maintain normal operations. A system that needs constant adjustment is not failing, but it is not at rest either. Think about what has changed over the last decade. Payment systems have become faster. Access has become continuous. Expectations have shifted toward immediacy. At the same time, buffers have been optimized downward to improve efficiency. These trends reinforce each other until they collide. When access is expected to be instant and buffers are thin, any delay becomes visible, any hesitation becomes noticeable, and any noticeable disruption carries psychological weight. That psychological weight does not dissipate easily. After an event like this, people listen more closely to explanations. They watch for repetition. They notice patterns. Even if balances are restored and functionality returns, memory remains. This is where broader conversations begin to surface, not about abandoning institutions, but about reducing reliance on any single point of failure, about redundancy, about maintaining options that do not depend on the same infrastructure performing flawlessly at all times. These conversations tend to accelerate after disruptions, not during calm periods. They are driven by lived experience, not theory. It is also where interest shifts toward assets that operate differently. Assets that are not claims on someone else's balance sheet behave in ways that feel reassuring when systems feel fragile. Their prices may fluctuate, their liquidity may vary, but their existence does not depend on overnight settlement or institutional coordination. That distinction matters when people think about continuity. Continuity is not about predicting outcomes. It is about preserving flexibility across scenarios, the ability to respond rather than react, the ability to function even if access is delayed or interrupted. This does not require dramatic moves. Small adjustments often matter more than sweeping changes. Spreading exposure, holding modest buffers, understanding where dependencies exist. None of this implies that the system will fail tomorrow. It implies that it is operating closer to its constraints than many assume. Operating near constraints is not unusual late in economic cycles. It reflects accumulated complexity, leverage, and interconnectedness. It also reflects the difficulty of reversing course once structures are in place. Systems evolve incrementally. They rarely reset smoothly. That is why attention to signals is important, not to induce fear, but to inform judgment. Signals provide context. They allow individuals to make decisions based on observation rather than assumption. This event provided a signal. It showed how dependent access is on continuous coordination. It showed how quickly confidence can be tested. And it showed how rapidly behavior could change if similar disruptions were repeated. The response from institutions will emphasize closure, resolution, a return to normal. That is expected. Stability depends on it, but stability is not the same as durability. Durability comes from margin, from slack, from systems that can tolerate surprises without requiring constant intervention. When margin is thin, surprises matter more. This is why discussions about value storage are evolving, not as a rejection of modern finance, but as a complement to it, a way to diversify across different modes of risk. Physical assets, by their nature, operate outside digital clearing cycles. They are slower to move, sometimes harder to transact, but less exposed to instantaneous failure modes. That trade-off becomes attractive when speed and convenience feel less certain. This does not make them superior in all circumstances. It makes them different. Difference is the point. As environments become more complex, uniform solutions lose appeal. Diversity of approach becomes a strength. In the final segment, we are going to bring these threads together. We will look at how repeated reliance on support mechanisms reshapes incentives, why perceptions of value are shifting, and how individuals can think about positioning themselves thoughtfully without overreacting. For now, keep observing. Notice how explanations are framed. Notice how quickly issues are declared resolved. And notice how often similar stories appear across different institutions. Patterns do not announce themselves loudly. They reveal themselves over time, through repetition. Understanding them requires attention, patience, and the willingness to look beyond the surface of reassuring headlines. At this point, the individual pieces should be clear. A brief interruption exposed how dependent access is on continuous coordination. Overnight systems hesitated, confidence was tested, backstops absorbed pressure, normal operations resumed. On the surface, the story appears finished. But the meaning of what happened does not end with restoration. Financial systems rarely fail in dramatic, single moments. They change gradually through accumulation, small stresses that require intervention, minor disruptions that become normalized, temporary measures that linger. Over time, these adjustments reshape incentives and expectations. What matters most is not whether a balance briefly displayed zero. It is what that moment revealed about margins. Modern banking is built for speed and scale. It is extraordinarily efficient when conditions are stable. But efficiency compresses slack, and slack is what absorbs surprise. As conditions shift, the system adapts by leaning more heavily on support mechanisms and communication strategies. That adaptation can sustain stability, but it also reinforces dependence on confidence. Confidence that access will remain uninterrupted. Confidence that assurances will be honored. Confidence that support will appear when needed. Confidence is not guaranteed. It is maintained. The event you experienced accelerated awareness of that reality. For many people, it transformed an abstract concept into a personal observation. Once that happens, behavior adjusts, not dramatically, quietly. That quiet adjustment is how environments change. Some people diversify accounts, some keep modest cash buffers, some pay closer attention to institutional exposure. None of these actions signal panic, they signal learning. Learning reshapes systems over time. As perceptions evolve, so does interest in assets that behave differently from database entries, not as replacements, but as complements. Ways to hold value that are not dependent on the same access channels. This is where physical assets re-enter the conversation. Physical silver, in particular, occupies a unique position. It is small enough to be accessible, tangible enough to feel real, and historically connected to monetary systems without being controlled by them. Its price moves, its liquidity varies, but its existence does not depend on overnight reconciliation or institutional permission. That distinction is why silver attracts attention when confidence in digital access is questioned. Over long periods, silver's value reflects cycles of abundance and scarcity, confidence and concern. When systems feel robust, interest wanes. When systems feel stretched, interest returns. The current environment combines several forces that tend to draw that attention. Persistent fiscal pressure, elevated interest rates relative to recent history, heavy reliance on intervention to smooth volatility, and increasing awareness of how centralized access can be disrupted, even briefly. Price targets become part of the conversation not because outcomes are certain, but because historical relationships reassert themselves when conditions change. Ratios adjust, demand shifts, expectations recalibrate. Silver moving significantly higher would not require collapse. It would require continued recognition that diversification of value storage matters. That recognition is already underway. This does not mean abandoning the financial system. It means engaging with it more consciously, understanding its strengths and its limits, using it for what it does well while reducing exposure to single points of failure. The lesson of this event is not fear, it is clarity. Clarity about how access works, about how confidence functions, about how resilience differs from convenience. When systems are reliable, we forget they are systems at all. We treat access as an entitlement rather than a process. Moments like this reintroduce the process. That reintroduction can be unsettling. It can also be empowering, because once you see the structure, you can make informed choices within it. You can choose redundancy over optimization, balance over concentration, optionality over assumption. Those choices do not require extreme action. They require tension. As institutions move forward, they will emphasize resolution and normalcy. They will refine systems. They will review procedures. They will reassure. That is appropriate. Stability benefits everyone, but stability is most durable when it is supported by understanding, not complacency. The most resilient participants in any system are not those who expect perfection. They are those who plan for imperfection. The moment balances displayed zero was brief. Its implications last longer. It reminded people that access is conditional, not absolute, that confidence is central, not peripheral, and that value can be stored in more than one way. Those reminders tend to surface during transitions. Transitions do not announce themselves loudly. They reveal themselves through moments that feel small at the time and obvious later. This was one of those moments. What you do with that information is up to you. Some will ignore it, some will forget it, others will integrate it quietly into how they think about money, access, and resilience. That quiet integration is how systems evolve without collapsing. As attention shifts, as diversification increases, and as conversations about value storage broaden, assets like silver will continue to attract scrutiny. Not as predictions, but as signals. Signals of a system adjusting to its own complexity. In that context, silver reaching levels once considered unlikely would not be a shock. It would be a reflection of changing assumptions, a reflection of renewed interest in tangibility, a reflection of people responding thoughtfully to what they have observed. The story that began with a zero on a screen ends with a clearer understanding of how much that screen represents. Not just a number, but a network. And once you recognize the network, you can navigate it with intention rather than surprise. That is the real takeaway, not urgency, not alarm. Awareness. Awareness is what allows systems to be used wisely. And wisdom, over time, is what turns moments of disruption into foundations for resilience.